guess before I do that, let me go back a page. So let's talk about why carriers are making moves. And generically speaking, they're making moves because of two words called interest rates. So the average person doesn't think about how important interest rates are to insurance companies. And I got into this business in 2000, and what I've basically seen, generically speaking, is I've seen a reduction in interest rates that you could slide down, could slide right down the hill. And that gives a lot of pressure to insurance companies who have to sit and steward large reserves. Sometimes many, many, many billions of reserves have to be in relatively safe and secure investments. And with interest rates low, their spreads are lower, which means that they can't make as much money, which means they can't offer as robust interest rates, they can't offer as robust products. And as interest rates continue to rise, they get a little bit of pressure relief, in my words, which again allows them to do some pretty cool things. And even on the annuity side, we're seeing right now, we have 5-year annuity rates in excess of 5%. I think guys even pushing 5.5% at this point. Is that true, Andrew?
Yeah.
Yeah, so it's a pretty exciting time to be in the insurance business, right? Because I think there's going to be many opportunities, and we're seeing that in the long-term care space. So I would say that's really why carriers are making moves. And then what moves are they really making? So relative to long-term care, let's highlight a couple of the companies that we have. The first here is Lincoln MoneyGuard. Some of you may be familiar with that. They've recently repriced their product. They tell us it's an 8% reduction on average, but the real sweet spot is they've reduced about 10% for those over age 60 and about a 3% reduction for those under age 60. So it's repriced. They also have now included a cash component. So traditionally, the Lincoln MoneyGuard product is a reimbursement product, which means that we not only have to qualify for the care, but we have to submit actual receipts, and then they reimburse for actual costs. Well, MoneyGuard in their newest iteration has allowed for 50% of the monthly benefit to be able to be paid in cash to the extent we want. And so that's a good thing. I personally don't have an issue with reimbursement policies, but cash is always king, and cash is better. And if we have cash, it's one less step, one less hurdle that we have to jump over. And it also perhaps allows us to hire an informal caregiver. And that might be very important depending upon what our client situation is. Maybe a daughter or a niece or a spouse can possibly even be paid to be able to do some of this care. Now, I've never seen the third bullet point here before. I thought that was sort of an interesting thing for them to do. What we find is that you get a couples discount in almost every long-term care structure. And the real reason you get a couples discount is because couples tend to take better care of each other and go on claim longer or go at a later date, right? And so MoneyGuard has a special right now that even if you're single, they're going to give you the couples discount up until the end of the year. Okay, and so I think that's sort of interesting. And then the last
And
bullet
by the
point
way,
is,
Rod, that's 18% improvement in pricing to
wow,
have that couples discount. So it's a huge opportunity for those clients that may be widowed or single that are looking for long-term care coverage. So again,
I
either you
wouldn't.
having a price reduction by 18% or for the same premium, your LTC benefit is higher by about 18%.
Yeah, that's wonderful. I actually didn't know it was that significant. That's incredible. And then finally, they do have a 0-day elimination period. Now, again, most of our products are a 90-day elimination period, and I personally have no issue with that. Most of our clients, we're not trying to protect them from short-term care necessarily. We're trying to protect them from long-term care. But all things being equal, I don't want our clients to go on claim, but if they do go on claim, I want them paid as much as possible, as soon as possible. And from a competitive standpoint, if they get paid at day 1 instead of day 90, that can be very significant. So pay attention to Lincoln MoneyGuard. What I'll tell you in our practice is it's been a couple of years since they've really had what we would consider to be a very good and competitive product. But today they're at the top in a lot of scenarios. You have any other comments about Lincoln on that basis, Andrew?
No, and to add on top of that, they really made the application process, very streamlined. You can actually now submit an electronic ticket, which has a clean application every time. And most importantly, in my opinion, the phone interview is actually now done online by the client at their own convenience. So they don't have to be stuck on the phone at some weird, spot for 40 minutes. They can come back home from work and complete it at 10 o'clock before they go to bed if they would choose to.
Yep, I think that that's great too. I mean, anyone who's been around in the insurance business knows that the pain comes once the client says yes. And the client says yes, and we got to jump through a bunch of hoops and make sure we're appropriately contracted and licensed. We got to pull together all the paperwork. And so to the extent that we can streamline that process, it's better for everybody. And to Andrew's point, Lincoln's doing a pretty good job on that basis. All right, so that brings us next to Nationwide. Well, Nationwide Care Matters 2 has been repriced on 11/7. And so this was what, about 10 days ago. It's about a 5% price improvement on average. They are a full cash indemnity style benefit. So that's part of what makes them unique. It isn't a reimbursement model, it's just all cash, right? And then they've also allowed that any policies that were in place prior to the 7th, they're going to give that pricing to. So if you had something in underwriting, they've actually then retroactive, which only makes sense because if they don't do that, then what we probably do is we would have to terminate the application and submit a new one and then put clients through hoops, and that doesn't really make much of a sense. Andrew, where are you seeing the sweet spot for Nationwide, and what else would you share about what they're doing?
No, it's another behemoth when it comes to LTC space and this asset-based LTC space. Um, they also now made some streamlined processes to their application. Again, e-app is available, electronic phone interview option is available for the client, and sweet spot typically is 6-year benefit with 3% COLA. You know, you're looking at ages typically 60 plus. One thing that's interesting with Nationwide Care Matters too is that the issue age, I believe, is 30 right now. So, and they do have paid up at 65 options. So this is something, for example, I'm considering for myself and for my wife. You know, I'm in my 40s right now. Uh, Crazy to say that.
Can you believe it?
Um, yeah, but this certainly allows now entry point with some young professionals who may not have $50,000, $100,000 to allocate as a single premium, but they certainly have healthy income coming in, and they could do $200, $300 per month, and then see potentially $1 million of long-term care benefit in their 80s.
Yeah, I love that. And to that point, most people tend to wait till they're 60 or 70 to address long-term care needs. I got to tell you, that's not that great of an idea, right? It gets more expensive, and then really health is a concern. Where I think the sweet spot is, especially for these, are those younger individuals with high income. And if we can take a 10 pay, a 15 pay, or maybe pay to age 65, that might actually be the best thing. Not only can they lock in lower numbers, but most importantly, they don't have to keep that expense with them in retirement. And,
Right.
and so that's something to really consider. And practically speaking, the younger clients, they always have multiple needs, and so they could be conflicting. But where I really find this is really those that are empty nesting. If you're 50, you're 55 and you're empty nesting, that can be a wonderful time to put a 10 pay type scenario in place. So think about that as we walk through here on which clients you need to have a conversation with, right? Because at the end of the day, our job really, in my opinion, is to motivate our clients to operate in their own best interest. And to the extent we can help arm you with that, then we can help your clients. And then ultimately we get what we want. That's that platinum role, right? To the extent that we can understand and meet your needs, then our needs are ultimately met. So hopefully, again, you'll take some from this call about how we can do that and some of the tools that we can help you do that with. All right, so moving along, now you got One America. Well, One America is very interesting because they offer a joint long-term care product. So it can insure both people on one product. And there's multiple different designs to be able to do that. What also makes it unique is they can take qualified money, not just non-qualified money. So they have a bundled structure whereby you can take a rollover, let's say $100,000 from the qualified account into a qualified annuity. And then over 10 years, that qualified annuity then spits out income for 10 years that's taxable to the client because it's been pushed out of the retirement account. Those dollars are then repositioned to buy a life insurance and long-term care combination plan. One of the changes they just recently made is they're giving us a 20% bonus. I believe it was down at 10%. And now they're giving us a 20% bonus on the money that goes into that rollover IRA. And so this can be a really great situation for the right clients. And again, what makes it unique, I'm not aware of any other second to die structure that has long-term care riders outside of an annuity structure. Are you, Andrew?
No, and yeah, One America by far I think is the most innovative when it comes to their chassis and how they're able to take qualified funds. And by the way, even if let's say husband has IRA into his name, you can still have joint coverage funded by only husband's, let's say, IRA rollover. So you don't have to, make sure that, okay, we have husbands and wives IRA. So that is very unique. And some advisors have positioned that 20% bonus by saying, okay, because we have to spread out that IRA rollover over 10 years to fund life LTC structure, and you have to pay taxes obviously on that amount that's coming out on an annual basis for the next 10 years. The insurance company is giving you 20% bonus to make up for some of those taxes that you have to make. So if you do a $100,000 rollover, they give you $20,000 free money, so to speak. So now it's $120,000 spread out over 10 years. So it's 12,000 per year over the next year that will go to fund life LTC combo, and the client is taxable on that 12,000 as opposed to $100,000.
Yep, it's a very good point. And what I really like about it is, when we get down to it, we always need to figure out where the funding is going to come. If we're going to put insurance in place, it has to come from somewhere. And so with the right kind of client, the idea that we can just simply reposition 100,000 or maybe 200,000 from the retirement account, a lot of times that can be a lot more palatable for a client than to have to pay out of pocket. Right. And so the right answer is it's always depends. And I believe a lot of what we can bring to clients is giving them a couple of options so that we can shortcut and we do the pros and cons. And so if you haven't looked at One America, I suggest that you do. And again, they're someone that we use quite a bit on this basis. Okay, next we have Global Atlantic. So Global Atlantic has a 4-care annuity. And what's interesting about this 4-care annuity is it's about the most make it the easiest way to qualify for care. So it's a simplified issue product, and it's easier to qualify for this product than any other product on average. And depending upon how you're approved, you either get approved at 2 times or 3 times what your contribution is. So if you put $100,000 in, it either turns into 200 or 300,000 immediately. There is the opportunity to have a COLA protection, that's cost of living adjustment. We can add that onto this type of product. Just like or similar to the One America, we can do a single or joint coverage on this basis. So if you go, well, wait, a lot of times where we're funding these from are old non-qualified annuities that might have low basis. This is what makes this strategy so interesting to me, is that if you use a product like that for long-term care purposes, the money comes out completely tax-free despite your basis. So if we had a $30,000 basis and a $100,000 value in an annuity, and we moved it into this product and we got 3 times leverage, we would effectively create a long-term care bucket of $300,000, and we could exhaust that entire bucket income tax-free despite the fact that we only have a $30,000 basis. And so that can be very appropriate as a funding vehicle if you're thinking about clients that you have that have non-qualified annuities that are not needed in the income plan. That could be the perfect place to do this. And if that's in the gentleman's name, for example, we can 1035 that into this product and add a joint rider. And that's what technically allows us to take a single life annuity and create a joint life benefit. And so this can be very interesting. One of the changes they made is they've increased the interest rate assumption to 5.5%, which again, I haven't seen 5% numbers. My team knows that I kind of geek out a little bit for some reason about 5%. And it's because I haven't seen 5% numbers in a long time. And now we're seeing that here. And so again, interest rates cause havoc on a lot of things, but they actually help us on the insurance side. So pay attention to that. Am I missing anything on this? What else would you add?
Yeah, maybe just zero in a little bit on, positioning of this particular product. As you mentioned, this is probably one of the easiest products to qualify for. Really, all you need to do is just have the client answer health questions on the application. We submit it, and within a few days, we get a response back saying the client is approved, either at Premier or standard class. Please submit the full application. It's literally that easy. If the client is over age 70, they have a quick 10-minute phone call to do a cognitive test, which is a word recall, but there's not going to be an extensive personal health history
Yeah.
phone call that you'll have to do with the client. Now, this product really shines if the client is getting maybe a little bit older. 70, 75, this product goes, I think, all the way to age 80, maybe
At
even
least 80.
85. I believe 80, yeah. But when you think about it, the cost of life insurance becomes quite expensive the older you get. So this is where an annuity with LTC rider becomes now more competitive than some of these life LTC structures. And the way to look at this product really is in the spectrum of what happens if you live, what happens if you die, what happens if you quit. And if you live, you need long-term care, you potentially triple your deposit. If you passed away, guess what? Your beneficiary gets full accumulation value, which is your deposit growing at that 5.5% interest rate. Again, great value for the beneficiary if no long-term care was needed. And if something comes up, you want to quit, guess what? There's a cash surrender value that you can take and walk away and do something else with it. So it's got a lot of flexibility, very good leverage, easy to qualify, and let's not forget, it's a competitive compensation as well. I think it's like 7% or something like that.
Yep, sounds right. One last thing I would state on this is that there is a knockout question. There's several, but one of the knockout questions is if they've been declined in the last 12 months by any other carrier. So sometimes people will keep this in their back pocket and say, hey, if we get declined, we'll go move here because it'll be easier. You won't be able to do that. And
Right.
so you'll hear when we go into tips, one of the things is before you quote, and certainly before you submit any business, you really do have to have an understanding of your client's health. And if you don't, you're putting your client at a disadvantage and yourself at a disadvantage. So we really do need to appropriately vet insurability before we submit business. All right, beautiful. Moving on. So those are the carriers who are really making the moves. We highlighted 4 of those. Now we're going to talk a little bit about what happened in Washington. And could that happen in the state that you're in? And I find this kind of funky, to be honest with you. So I don't know how many of you are aware of what happened last year. But Washington State was the first state that effectively said, you need to buy your own long-term care insurance, or we're going to automatically enroll you into our long-term care insurance. And we're going to do that by automatic payroll deduction. And the plan that they put together was 5.8% or 5.8 cents per $100 of earnings to be able to create a total benefit pool of 36,500, meaning that's the entire benefit. 36,500. And they're saying if you don't buy your own policy, then you are going to get this policy and we're going to charge you. And by the way, there's no cap on income. So if you earn $40,000, they're going to take 5.8 cents per 100 from you. If you make $1 million, they're going to do that each time as well. So it's actually sort of reversely discriminates against high wage earners for a very low benefit of 36,500. Furthermore, a normal long-term care policy that we would present would have a requirement to achieve a 2 or more of the 6 activities of daily living in order to be eligible for the benefits. This one required 3 out of the 6. So it's harder to get and a very much smaller benefit, right? And so I don't like this plan personally. But why we're bringing this to you is we want you to know what happened. First of all, Minnesota, California, New York, and Pennsylvania right now are currently considering very similar programs. And what happened last year was that 480,000 people in Washington opted out of this plan by buying their own personal LTC. So what that means is we had a huge influx of business. If you wrote any long-term care business last year, you probably remember how long it took to get that thing placed because the insurance companies had over a 200% increase in demand due to just one state implementing this. And so if another one state does this, we're probably going to have a similar issue if they're not stocked up enough. And what happens if 3 or 4 or 5 or 10 states do this, right? This could be problematic. Exactly. So we can be more proactive. I'm not a scare tactic guy, but if you wait for this to come to your state, what's going to happen is you're going to get inundated by calls from your clients that say, what does this mean? And then we might be in a spot where our pipeline is clogged up. And so now you're reactive, you're getting calls, you're trying to help your clients, and then we're in this spot where we're in quicksand or in mud because there's so much volume. And so that's another reason, in my opinion, to get ahead of that. And that's why we're beautiful. Moving on. So if they're making moves, and we know we have to have intentional conversations, and we have the products and we have the clients to talk to, we need to have a process, and we need to be intentional on how we bring this to our clients, right? If we just call our clients and say, do you want to buy long-term care insurance? The answer is going to be no, absolutely not, right? So that's not what we're going to need to do. We are going to have a process. And so I'm going to outline to you a suggested process that we use here. I'd like you to take what you like and drop what you don't, right? But this does work. In order to have this kind of conversation, the first thing we need to do is we need to identify who we're going to talk to. Now that might seem easy, but we got to go, well, who are we going to talk to? So literally, who are we going to talk to about this? We're going to describe this a little. Then if we know who we're going to talk to, we have to determine how are we going to bring it up. You're very likely not just going to pick up the phone and say, let's talk about insurance. So how can we do that? How can we make that more palatable? So what are the entry points? Then we have to be able to talk to them. And so when we talk to them, we're going to suggest to you that it isn't always about talking about what kind of risk they have. It's really about the consequences that would occur. And so when we talk about long-term care insurance, I personally believe that we're really talking about retirement portfolio protection. And because if our clients need care, I believe they're going to get the care that they need. And if they get the care that they need, it's going to cost something. If it costs something, they're going to be paying for all of that themselves, absent some sort of long-term care plan. And if they do that, there may be consequences to the family. What could those be? They could be mathematical, they could be emotional, they could be physical. And so we're going to describe that a bit. At the end of the day, if we have the right kind of person, we know how to bring it up and we can steward the right kind of conversation. What we're really after is having them declare a plan of care. What would they want to have happen? Not about insurance, if you follow me. We haven't even talked about insurance yet through this process, right? We talked about what the consequences were if this would occur and what kind of plan they would want to have in place. Only then do we talk about what are the options for funding that plan. And so in the next few minutes, I'm going to walk through each of these and suggest to you a process that can maybe make it a little more palatable for your clients, which in our words is about shifting what insurance is to what insurance does. I think there's very few people who like what insurance is, including myself. Insurance is messy, it's complicated, it's contractually driven, there's a lot of paperwork, et cetera, but I like what it does. And what does it do? Well, it really solidifies our financial plan. It solidifies our goals. It makes sure that our legacy can be secured, right? And so we have to talk to clients about what's important to them. We need to make sure that we touch their heart before we touch their mind. And that's why we can't just go in with insurance quotes. You go in with insurance quotes, you're only touching their mind, and their mind's saying it's too expensive and it's not going to happen to me. And so we have to touch their heart and ask them what's important to them and how would they feel if something like this occurred, and then ask them whether or not they want to accept that risk and consequences themselves, or would they like to transfer or eliminate some or all of that risk. Before I get into this, Andrew, would there be anything else that you would want to add?
I find it that's probably the easiest way to have that conversation is to ask for a permission to help them with a plan of care. That does two things. Nowhere in that sentence the client heard the words long-term care. So two things will happen. I think first of all, the client will say, do you mind if I ask you what the plan of care is and why do I need it? And now it just gave you a segue to answer that question and proceed into deeper conversation. Well, the plan of care really is, where do you want to receive care in the event that you need some assistance in your later life? Who do you want to provide that care for, and how we're going to pay for it? I'd like to help you with some of those questions. And I don't think any client would say, no, I really don't want any assistance or your help, with putting together a plan of care for me. So it's, again, a great way to open up that conversation without really bringing up long-term care.
Completely agree. And if you've already done a financial plan for your clients, it becomes that much easier. It's just a continuation of the plan we put together.
Mm-hmm.
And that's really why we work with wealth advisors. And I do a lot of joint work personally with wealth advisors. And by the way, as you walk through this, if you like what you're hearing and you're not comfortable or don't want to steward this conversation directly with your client, you could certainly bring me in and we could do some joint work together and share commission. You certainly do not have to do that, but many advisors have chosen to do that. And I want to make sure you're aware that I'm available to the extent that you would want that. So let's dig into that a little bit. So we got to find the right person. So generically, I think we can put our clients into maybe 3 categories, or certainly people, those that might be Medicaid likely. Well, if they're Medicaid likely, that probably means they don't have much assets or their income may not be high. They may not even be our clients, right? If they're our clients to begin with, they have assets under management generally. And so I would say for our purposes, we ignore those that may be Medicaid likely. They may not even be able to afford the coverage anyhow, and what are they really protecting, right? So then that leaves us really with the middle class and the wealthy. Now, how are we defining middle class and wealthy? You get to define them however you want. But the fact is that these are the people that have more at risk as far as assets go, and those that also can perhaps afford to transfer risk and pay some premiums. Okay, and so we need to think about, who do we have that's middle class and wealthy, and those are the people that we really ought to be paying attention to. Now we have to decide how to talk to them, right? And where do we bring it up? And I suggest there's really three places that are most appropriate for bringing it up. The first could be in the annual review. I've been in a lot of annual reviews, and if most of the annual reviews I've been in have been an hour long, approximately 45 or 50 minutes of how was your last vacation, how's the family, what's going on, and in the last 10 minutes pulling out the investment reports and say, here's how your portfolio is doing, and we made a couple of changes. Well, if that's your annual review, there's a lot of time in there. This could be an opportunity to say, hey, your investments are doing great. Do you want to talk about what could keep your goals from coming to fruition? Would you like me to stress test your portfolio from an event that could potentially occur? By the way, I'm most concerned about the non-ill spouse. Okay, the spouse that needs care, in my opinion, is going to get the care that they need. It's the other spouse that's going to have the biggest burden. Right? They're going to have an emotional burden for sure. There may be a financial burden because the dollars are being spent, $12,000 a month in a nursing home. How many people can effectively incur that double dipping? I call it a double dip. Well, we're trying to live on $8,000 a month, for example. We got to come up with another 8,000. Where's it going to come from? And it's the healthy spouse that ends up shouldering a lot of that burden. So I might suggest annual reviews, number one. Second would be personal experience. Just start asking questions. Have you ever seen anybody that has needed this kind of care? What was that like? What do you know about that? What do you see? What I find is if somebody has a personal experience, the conversation is night and day different from somebody who didn't. In fact, sometimes those that had close personal experiences, they want to jump right to buying product because they already know. They already know what insurance does. And they want to jump right to the product, and we have to slow them down. And so just ask clients, have you ever seen this? How do you feel about that? All right? That would be a second way to enter. And then third is in the financial planning program, right? This longevity. If you're running financial plans, you're almost certainly running those financial plans out to age 90 or 95. And if you're running out there, I see these things, you're in the green. Congratulations, Mr. Klein, you're in the green. This is 97% success, right? Well, Mr. Klein, how would you feel about the effect that a long-term care event might have on that? Do you believe that if you could live to 90 or 95, the likelihood that you might need care would go up, or would it go down? Right? That's a way to bring it up. I
And
happen to
would you
believe
want to absorb that expense yourself, or is it something that we want to outsource to the insurance company?
that's exactly right. Because if we know that we have this risk and this consequences, we only have those two options that Andrew alluded to. We can either accept that and keep our money, or we can allocate some of our money, maybe reposition some of our money, or maybe at that $8,000 a month that I'm trying to live on, well, maybe I could reduce that to $7,500 a month and take that other 500 and transfer some of that risk. And so a lot of what we do is really helping clients think this through, because what they think is, I don't want the insurance and it's not going to happen to me. And I think those things are valid, right? I understand you don't want insurance, and I understand you're an optimist, but we're in the planning business. This is so important because So few of our clients are going to die prematurely during their working life. I really believe in life insurance. I deal with it every single day, but I'm telling you, mathematically, most of our clients are not going to die during their working lives. Okay? Same thing with disability insurance. The majority of our clients are not going to become disabled during their working lives. I believe in these coverages. I place them every day. Long-term care, I believe the majority of our clients are going to need long-term care. I'm not a big statistic guy, but the statistic is 50 to 70% of people today, and I believe it's going to go higher. Why is it going to go higher? Because we're living longer. That's the whole reason for long-term care anyhow. To the extent that we live a long life, the likelihood we need help living goes up. And that's why the financial plan is perfect, because we're going, hey, we want to run this to 90 or 95 so you don't run out of money. You go, well, let me stress test that portfolio. Let me run a what if scenario. You're using Money Guide Pro, for example. Run a what if scenario and plot what that future long-term care risk might be. And you can stress test that portfolio. Ask them how they feel about that. Okay. So those would be entry points. Then again, the conversation, you're already hearing part of the conversation here. But we really have to define what's long-term care, because so often people think that long-term care means that you're flat on your back in a nursing home and can't do anything. And that's not our experience. I'm going to show you in a minute that a very small percentage of long-term care is actually performed in a nursing home. A lot of it's at home, assisted living facility, and others. And people think nursing home. Well, listen, I don't want to go in a nursing home either. Okay. Well, we do not require confinement for most of our structures, confinement to a nursing home. The care can be performed anywhere we want, and it often starts at home. So we need to make sure that they're aware of that. You know, the when and where does it begin? Because it doesn't begin in the nursing home. It's the last stop. People go into the nursing home because they don't have any other options generally. Okay. And then we talk about the risk and the consequences. So the consequences are really maybe threefold. Emotionally, right? I call it an emotional catastrophe. If a client needs long-term care, I promise you there's an emotional catastrophe in the family. There's no way for it to not be. So we already have an emotional consequence. If we have a mathematical or financial consequence at the exact same time because we haven't planned for this, then what we have, in my opinion, is we've put a magnifying glass out on our lawn in the sun, and we're going to watch everything go up in flames. Okay, so you got this emotional risk and consequence. You got the financial. Then you even have physical. Well, what am I talking about there? I'm talking about this spouse who's often providing some of that care. There's study after study that indicates that they themselves can have physical issues by being able to do this. By the way, they might be trying to work as well. And so it might compound a mathematical issue if the person is still working. So all of this to say, we have to ask our clients how they feel about things. Have you ever thought about this? What are your thoughts about this? How do you feel about this? Do you want to become educated on what your options are in this area? Right? If we set that all up, then well, is that about insurance, Rod? Well, it could be about insurance, right? Well, I don't want to buy any insurance. Well, good, you're smart. I don't want to buy any insurance either. But if you were educated on what your options are, you might find that you might want some of it, because when you really look at the risk we're talking about, it can be in the hundreds of thousands of dollars. It can be in the millions of dollars, right? You want to provide the care, coordinate the care, and then who or what's going to pay for the care? Well, I don't want insurance. That's good. I didn't ask you to buy insurance. I asked you what's going to pay for the care. And what I find is that people rarely liquidate their highest yielding assets to be able to do this, but they don't think it through. They go, well, I got this portfolio. My portfolio is worth $1 million. Well, it was worth $1 million last year. It's worth 800 or 850 this year. And by the way, if I'm counting on my portfolio to pay for this, what happens if I need care in a down year? What about the people who wanted to pay this year out of their portfolio? Are they happy that they made that decision? Now we're redeeming shares in a down market. I don't want to get negative. I don't want to get too robust about it, but people don't think about this stuff because what they think about is insurance bad. So, well, wait, let's think about it. What are our options? So that's if they're going to use the portfolio. Well, what you might find is they go, well, actually, I've got money in the bank. That is my emergency fund. Now, by the way, as an aside, do you think it's possible any of your clients have money in the bank that you don't know about? Because I think it's very possible. And they might have $100,000 or $200,000 in the bank. And I've seen some people with $500,000 in the bank recently earning less than 1%. These interest rates that have increased, it hasn't shown up in the bank accounts yet. So if they're specifically thinking, well, my bank account will do that, that's almost the best case scenario from our point of view, because we can show them how they can reposition that part of that asset that's in the bank earning 1% or less that's taxable and reposition into one of our products that might give us 2, 3, 4, maybe even 5 times leverage depending upon what we do. And so, and by the way, still haven't talked about insurance if you followed me. Still have not talked about it. Just where do you want it to receive the care? Who do you want to do that? How do you want it to be coordinated? What's going to pay for it? With a distinct understanding that insurance is not the plan. It just can possibly fund the plan. And by the way, it almost never funds all the plan. Most of my recommendations are in approximately the 50% range, 50% of what the anticipated cost might be. And so really the business we're in is custom designing solutions for clients based upon these items and what's important to them. Right. Andrew, any other comments on the plan itself?
We have a really nice plan of care worksheet that we'll be able to send you out from Secure and Financial, and it does have all these thought-provoking questions that I guarantee you your clients are definitely not thinking about. But we'll certainly get this conversation going, and I think it's going to make your job much easier than to bring some of these solutions once the client gives you the nod that yes, let's seriously talk about this.
Yeah, love it. So what is a typical plan of care, right? It's a plan that allows you to stay safe in the comfort of your home and protects your family, right? That's really what it's all about, right? And that's that heart stuff, right? Heart and mind. I want to be safe. I want my family safe. I want to mute my consequences. Okay, here's some stat claims from MoneyGuard that Andrew pulled together for us. Average claim at Lincoln MoneyGuard is 23 months. Okay, 23 months at what cost, right? Is it $5,000 a month? Is it $15,000 a month, right? Even at $5,000 a month, that's over $100,000, not insignificant, right? Type of care, 46% in assisted living or residential care, 46% in home health care, only 7% in nursing homes. So again, the average person thinks we're talking about nursing homes, and we're not. Only 7% of people are getting care in nursing homes that are on MoneyGuard clients, right? Claims by gender, 71% female and 29% male. That shouldn't be surprising to you. The real reason for that, the simple reason for that, is women outlive men by 5 to 7 years on average. And if they outlive men by 5 to 7 years on average, that means they live longer, they need care at a higher prevalence. And so the average thing that happens is a man dies 5 to 7 years before the woman, and the woman needs care for the last 2 or 3 years of her life before passing away. Right? And so that's what we're seeing here. And we again, by the way, as this happens more and more, these conversations get easier and easier because of that comment about people who've had personal experience. This conversation is dramatically different than those that haven't. And over the next 10 years, I believe we're going to see an enormous amount of people who are going to have this type of experience. And they're going to see just exactly how important this is. And back to my comment that I think it's important to protect our families with life insurance and disability. I believe in it. I present it every day. My family's protected that way. But the real risk, in my opinion, is really this long-term care. That's going to be the cost. Okay? So at the end of the day, if we have this plan, we go, well, what's going to pay for the plan? Okay, well, Medicare is not going to pay for the plan because Medicare is really health insurance and it's only going to last for 90 days effectively. Well, Medicaid will absolutely pay for every one of our care as long as we spend almost all of our money down and we're willing to go into a nursing home. You have to be in a nursing home for that. And by the way, they give you a 90-mile radius from your home that they can place you. Okay? Most importantly, for our best clients, it's going to be the most expensive option on earth because we have to spend down our clients' dollars first to a level to be able to be eligible for Medicaid. Okay? So then we move into self-pay. Well, self-pay is real. I think it's legitimate. But we have to ask ourselves, can we cash flow that additional amount? I have $4,000 to $10,000 here. I just told you that it's $12,000 in Minneapolis for a private nursing home. But can we cash flow that? It's legitimate, but let's ask it because people are saying, no, they just don't want the insurance. But you go, but wait, how would you feel if $100,000 came out of your portfolio this year? Right? And that's a different story. So then we get long-term care insurance. I mean, what I find is that if you walk clients through this, what you find is they go, yeah, I can't take all of this risk, but don't kill me on the premiums, right? They get in this spot where they know they have to do something, but they still don't want to do something. And that's what we want, because that makes sense. Because anybody who's really happy to buy insurance, something's not right. Nobody's like real happy. But if they're demonstrating their love for their family, that's why people put insurance in place. It's about their love for their family. And now we're back to touching the heart. Okay, so those are our funding options. We're at the top of the hour. We got about 10 more minutes. As I mentioned before, if you have to hop, I certainly understand. This is recorded and we're going to send the recording out to you. So Andrew already indicated, and I did too, at the end of the day, the clients only have two options. They can keep their risk and their consequences, and they can keep their money, or they can transfer some of their money in some way, shape, or form, and we can educate them on how to do that. Right? If we're going to get this done, we have to medically pre-screen. Okay, have to. At a minimum, I would suggest you ask these two questions at a minimum. Are you healthy as you look? It's a very generic question. It allows you to get into that conversation. It can be uncomfortable asking about health. Do you have any prescriptions? I often ask if they have any diagnoses, and 50% of the time they say no, everything's all good. And then I say, do you have any prescriptions? And they give me 3 prescriptions, which means they have 3 diagnoses, but they said they had none. So if you just ask for the prescriptions, a lot of times that will uncover it. I know it can be uncomfortable, but it's very, very important, because if you have known health concerns and you reach out to one of the 3 of us on this call, the first thing we do is we go out to our carriers and say, hey, I've got a guy, I've got a gal, here's what I'm looking at. How will you treat this person, so that we can better refine where they're going to be treated best? And we have to pay attention to this third point about mortality versus morbidity. Okay, if it's a long-term care only policy, they are underwriting for morbidity, the likelihood that I'll become disabled. If it's a life insurance only policy, then they're underwriting for mortality, the likelihood that I will die early. Understanding these are polar opposites of each other. Insurance companies, by the way, like to have a large portfolio of long-term care and life insurance together because they're complementary. To the extent that someone dies prematurely, they don't need long-term care. To the extent that they live a long life, they haven't died early, right? So they're complementary, but you need to pay attention to what the underwriters are looking for. And so there is a difference between mortality and morbidity. And in those that are combination plans, like the products that we showed up front on this call, they're underwriting effectively both ways, and they're placing them on each other to get the rate, right? So they're going to underwrite for mortality, underwrite for morbidity, and combine them together. Anything else that you would add on medical pre-screening? I know you know how important it is, Andrew.
Nope, I think you summarized it well.
Good. Beautiful. All right, so what are some ways that we can reposition or fund these strategies anyhow, right? So one of them is to consider repositioning our MDs. So I'm always amazed at how many people are 70, 71, and 72 years old that are taking RMDs, they're paying the taxes, and then just repositioning those dollars right back into an investment account. I'm not saying that's a terrible idea. What I am saying is you might want to consider peeling off some of those dollars and funding long-term care insurance. Even at age 70, it can look very good. I'm going to give you a quick example of that in a minute. Okay. One thing that I also think is unique is this can happen in a business application, especially a small business, a closely held business, where we can effectively use this as a benefit to pick and choose. You know, if I'm in business, maybe it's me and my wife and my one key person, right? Not subject to ERISA rules. So you could actually bonus dollars out to individuals and have them buy this coverage for themselves. And so it's pretty unique there. And I wanted to put that on that screen because a lot of people aren't thinking about that. And what I find is that a lot of times if the business owners aren't always the best investment clients because they're often repositioning dollars back into their business, but this could be a way to be very meaningful and provide a benefit, especially if it's a small business that maybe doesn't have a 401k plan whatsoever, but they want to be able to do something for their clients. This could be something for their employees. This could be something that we could use. Repositioning old life insurance contracts. There is old life insurance contracts, the proverbial mutual policy. It's a whole life policy that's got a $50,000 death benefit, $30,000 of cash. The client has had it for 30 years. You ask them about it, they go, I don't know why I had that. I bought that from my friend 30 years ago. It's not in the income plan, but it's got $30,000 of cash. Well, we could perhaps reposition that to either fund a brand new plan or maybe partially fund it. So we can roll it over via 1035 exchange and add additional premium to the extent that we need. Same thing with non-qualified annuities, as we've discussed before, especially those that have low basis. Okay? So with that, in the next couple of minutes, why don't I show you a couple of the supporting materials that we have. So I'm going to stop sharing and I'm going to share my other screen here. Okay, so give me a quick second. This should be screen 2. All right, Andrew, you're seeing Lincoln Money Guard?
You got it.
Beautiful. So this is that example with that 70-year-old that took RMD, right? So this is a male with a 6-year benefit. Instead of taking that $15,000 after tax, maybe it's $20,000. We paid 25% in taxes. Instead of putting that other $15,000 in the brokerage account, maybe we can take that $15,000 for 10 years and effectively buy a Lincoln Money Guard product that will give us a death benefit of $150,000 at the end of the day, which is the amount that they paid in, to the extent that we never needed long-term care. But on day one, look what happens. With $15,000, that 70-year-old who thinks that long-term care is too expensive, and you probably do too. That 70-year-old took 15 grand and turned it into a bucket of 289,000 that can be accessed at 37.33 a month for 6 years. And that number is increasing by 3% every year. So the average age of claim is about age 50, or make that age 80 rather. And so this person at age 80 would have a $5,000 monthly benefit or a $389,000 pool of benefits by repositioning $15,000 a year for 10 years. And so I think this is something that's not considered. And a lot of people, again, think that 70 is too late. I'm going to tell you that you should talk before age 70, but 70 is not too late. 80 is too late. I think 75, a lot of times 75 is too late. But I think 70, 71, 72, this can still get done. Andrew, you have any comments on that?
We actually had an 85-year-old covered with annuity care with One America. So I guess it's never too late, right?
Never too late. Never too late to consider it, right?
It's better later than never, I guess, maybe a better way to say that.
Yeah, I like it. That makes sense. So that's just an idea. We have a couple of pieces that we've alluded to. Okay, this here is our long-term care engaged planning conversation. This is kind of an agenda. It's a talking track. I personally think that this is the best piece we have, because if you can't have a good conversation, you have nothing. And so this allows and breaks down and sort of mirrors what we talked about. How to talk about what is the risk and what are the consequences. How are we going to create a plan of care? What's going to pay for that plan of care? Then giving an overview on the long-term care insurance overall, which we didn't talk a lot about due to time constraints today, but how do we qualify for the care? What are the main moving parts that are inside of these policies? How are claims actually paid, breaking down the reimbursement and cash indemnity? Then the 4 most common long-term care plans: traditional long-term care, life insurance and long-term care combination plans, et cetera. Even life insurance only can be used as a replenishment vehicle. Right? And so again, talking clients through this. Then the next steps would be, at the end of the day, we have those 2 choices, right? So we want you to do something that's meaningful and affordable to you. And so again, walking that through, we even address a couple common objections. Well, it's too expensive. Well, the biggest one there is, when you're expressing premiums, I like to express them as a percentage of income or a percentage of net worth, because any premium on its own is too expensive. We got to put it in context for each other, right? Money from savings accounts or investment accounts, we put 100 grand in the Money Guard program. It doesn't cost $100,000. What it costs is the opportunity cost of repositioning that. And if that's in the bank at 1% and it's not under management for you, boy, we can leverage that up. The opportunity cost is real low. Now it's much higher if we're pulling it out of the investment account, which we don't often do, but sometimes do in the right situation. Right? So again, more common objections. And then where do we find the funding? At the end of the day, where is the money going to come from? Right? And so this is a nice piece. Again, we're going to send these things out to you with the recording when we're done. Yep, that's exactly right. And I was scrolling through these just a little bit, so we're kind of we're short on time. I'm teasing you a little, But suffice it to say, at the end of the day, if you're going to be successful in this area, you have to have a game plan. And that's what we want to be able to do, is help you put together a game plan. And I suggest you take whatever material that we have here that you like, and you drop what you don't like, and ultimately figure out how you're going to intentionally get this done. If you want help from us directly, we're happy to help you. We can help you put together a business plan perhaps for next year if you want to go after this. We can put together with the help of, I mean, look at that. If you saw me scrolling through this one, that's why I really like this. I mean, Nationwide has long-term care in a box here. If you wanted to put together a program, social media, posts, emails, marketing assets, of course, make sure you're checking with your broker dealer whenever you're doing any of that to your clients, right? So let's go back here. Again, we just talked about this supporting material that we have. And again, we're going to send that out to you. And so our next Coaches Corner is December 15th. We do this on the third Thursday of each month. We do have an insurance advisor toolbox that houses all of our best stuff. If you've never seen that, please reach out to us and grab that. Please reach out to Andrew or George or myself on the next case. At the end of the day, if we do this right, we do the right thing for the client, we drive revenue, we protect assets under management, and we also create competitive immunity. Never forget that your clients are other people's prospects. And so if we want to do a better job for clients and drive additional revenue, that's really the reason that we're in business, or at least the reason I'm in business, is to help people and drive revenue. And so here's Andrew's conversation, or make that Andrew's contact information here. And this is George's contact information. And then finally, you have my contact information. So I'll wrap up the same way that we wrap up our Monday morning meetings, which is let's be good leaders, let's help our clients, and let's drive revenue. So I appreciate all of you. Have wonderful holidays, and please reach out to us on your next case. We're happy to serve you. Appreciate everyone. Have a great day.
Thank you.